Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 growth-focused tech stocks to consider buying before earnings. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these 3 stocks that are set to report their earnings next week, I quickly want to break down the broader market and some things we've seen so far this earnings season to give more context for the 3 companies we're going to talk about. So October's resurgence has pushed the S&P 500 back to new highs from breaking new highs from those early September records amid a strong start to the third quarter earnings season. So the bulls have really fought their way back into control of the market, at least for now, shrugging off supply chain worries, rising prices for everything from energy to consumer staples and other economic headwinds. So the current climb began right around October 4th when some big names fell into oversold technical levels. That includes the NASDAQ 100 tracking QQQ ETF. So it's then really gone on a big surge since then. The S&P 500 actually hit new records once again Monday morning. The NASDAQ sits about 1.3% below its highs, and the Dow also returned to new highs as well recently. As we said, a ton of uncertainty still remains heading into the winter and the holiday shopping period. And many traders and analysts had projected a much bigger downturn, with the S&P 500 having only really ever dropped around 5% from its records. Still, the positivity rolls on, and Wall Street appears somewhat sanguine about the U.S. economy and the American consumer heading into that vital holiday shopping period. On top of this, the early results from the Q3 earnings season have been better than projected, and guidance has been pretty strong. So the S&P 500 earnings growth and outlook has already climbed over the last several weeks, and the margins for the coming periods and the next couple of years look strong as well. And we should always remember that the interest rate environment is going to stay accommodating for stocks, even when the Fed starts to lift its core rate, which is just going to be an added bonus for the foreseeable future. So at the moment, for Q3 earnings, we're calling for about 33% earnings growth, which was up from just a couple weeks ago. We were calling for about 26% growth. So as the results have come in, they're outpacing what we were expecting on about 14.5% revenue growth. So that's for the S&P 500 for Q3. And overall for the year, we're calling for about 44% earning growth on nearly 12% revenue. And then we're calling for another 9% earnings growth in 2022. 7% higher sales, and then another 10% earnings growth in 2023 on another 7% higher sales. So after this big blowout year that came against the easier to compare 2020, we're calling for another 2 years of consistent top and bottom line growth for the S&P 500. And then this week will be pretty important, with most of the giant tech companies set to report earnings results in the last week of October, and that is Apple, Amazon, Microsoft, and many other mega cap tech stocks. But then if we look ahead to next week, we have some big growth focused names that shined during the pandemic and leading up to it that certainly are poised for more growth going forward. And we're going to talk about 3 of those stocks that are set to report next week, so the first week of November. And the first one of those 3 stocks we're looking at is Square, which trades under the ticker SQ. And its Q3 financial results are due out on Thursday, November 4th, after the market closes next Thursday. So now we're just going to jump into Square and then take a look at what to expect going forward and why it might be worth considering buying at the moment. So the company started over a decade ago by selling technology to help tiny businesses process credit card transactions from their smart devices. Today, the company is at the forefront of the ever-growing financial tech or fintech industry, and its sights are setting on becoming a really all-encompassing app and ecosystem for sellers and consumers. Its shares soared for roughly 12 straight months off the coronavirus lows, and its recent underperformance presents a relatively enticing buying opportunity, especially with a big acquisition set to close in early 2022. Square is, as we sort of alluded to, light years beyond the firm that sold those small smartphone and tablet-connected credit card readers geared towards small businesses and the self-employed. Its expanded portfolio includes a range of point-of-sale offerings, broader payment software and infrastructure, business loans, peer-to-peer payment apps, Bitcoin transactions, and beyond. So the company aims to be a wide-ranging financial services firm. This includes its relatively new Square banking offering for U.S. sellers that includes savings and checking accounts, loans, and much more. The company also offers a variety of back-end and online payment technology, and its business-focused fintech is catching on with larger sellers amid continued e-commerce revolution. So businesses, entrepreneurs, artists, really everyone in between needs to be on e-commerce selling their goods. In Square and the likes of Shopify and Etsy, which we're going to get to later, have really succeeded in this environment. So last quarter, the company processed $43 billion in gross payment volume, up 88% from the year ago period, with 65% of that coming from larger sellers, which it qualifies as anyone making over $125K in annualized gross payment volume. Bigger sellers accounted for about 57% in Q2 of last year. So 65% this past quarter, up from 57% in the year ago period. Wall Street also loves its ability to attract more consumers to its P2P platform, the Cash App, which competes against PayPal and offerings from Chase and others. The company reached 40 million monthly transacting active customers in June, and millions of its customers are now directly depositing checks to digitally pay friends and family and do much more. Plus, the Cash App also allows users to buy and sell Bitcoin, as well as stocks and ETFs. Square's ability to attract a younger generation of investors and compete against the likes of Robinhood offers huge upside potential. The firm said that roughly 4.5 million customers held a stock or an ETF in the second quarter, 3 times higher than the year ago period. Square is also clearly well on its way to becoming a holistic financial services firm where both customers and businesses keep, spend, and invest their money. The company also in early August announced its entry into the fast-growing buy now, pay later space with its planned acquisition of Afterpay. The all-stock deal is valued around $29 billion and is expected to close in the first quarter of calendar year 2022, so early next year. Afterpay is one of the leaders in the short installment payment ecosystem for options for e-commerce shoppers to purchase as part of a broader plan to integrate Square's seller business into its Cash App ecosystem as well. So the Afterpay boasts around 16 million customers and nearly 100 million merchants globally. And that buy now, pay later space is booming, and various fintech firms are offering the ability for buyers to make smaller incremental payments everywhere from some place like Nike to Home Depot. And Square hopes the integration will help, quote, even the smallest of merchants offer buy now, pay later at checkout, given Afterpay consumers the ability to manage their installment payments directly in the Cash App and give Cash App customers the ability to discover new merchants and buy now, pay later offerings directly within the app. We should also note that the company at the end of September announced a partnership with social media standout and Instagram competitor TikTok that enables sellers to send fans directly from TikTok videos and ads in shopping tabs on their profiles to products available in their existing Square online store. So just more of an integration between the two where make it easier for people to buy. And now we're going to look at some more of their growth history recently and then look ahead to what to expect going forward. So Square steadily expanded its revenue since its late 2015 IPO and had a big blowout year last year driven by the nearly overnight need for digital payments and e-commerce. So 2020 was a big year with sales up 102% to $9.5 billion. Most recently, its Q2 revenue then climbed 143% and 87% excluding Bitcoin revenue. Its transaction-based revenue climbed 80% and its subscription and services climbed about 100% higher. And its adjusted earnings surged from 18 cents per share all the way up to 66 cents per share last quarter to blow away our Zacks consensus estimates. Looking ahead, its Q3 earnings are projected to climb 15% on 51% higher revenue. And then if we look for 2021, its sales are set to soar another 99% to reach a whopping $18.89 billion, up from just $4.7 billion in 2019. So back-to-back years of about 100% growth is really impressive. Meanwhile, its adjusted earnings are projected to climb another 120% this year to $1.84 per share. The company is then expected to follow up back-to-back years of roughly 100% top-line growth with another 12% higher revenue in 2022, pulling in $2.3 billion more, or what amounted to its total FY 2017 revenue. And its adjusted earnings are projected to climb another 23% higher. So this is really 3 straight years of rather impressive growth for Square. Square's positive earnings revisions help it land, or had helped it land until recently a buy Zacks rank, but now it sits at a number 3 hold. The fintech firm also has crushed our bottom line estimates by an average of 111% in the trailing 4 quarters. And now we're going to take a look at some stock price movement. Its shares are up about 1,900% in the past 5 years and around 270% in the last 2 years to outpace its industry's 70% average climb. And then if we look in 2021, the stock has underperformed the market so far. SQ's up about 19%, and it's been relatively choppy. That said, it's seen some positivity recently, along with the broader market comeback. It climbed about 1.9% as the last time I checked Monday morning to around $257 a share, which sits at about 9% below its record. So that's a solid entry point for investors considering this, especially as a longer-term buy and hold stock. Wall Street also remains really high on Square, with 16 of the 29 brokerage recommendations that Zacks has at strong buys, with only one recommendation below a hold. So therefore, investors with longer-term horizons might want to consider buying Square, even if there's more volatility in the near term with the market, as this is a longer-term play on a new financial age. And now we're going to move on to another stock that reports next week, and that is Roku, which trades in the ticker that is its name, ROKU, and it reports its third quarter financial results after the market closes on Wednesday, November 3rd. So next Wednesday. The basic pitch for Roku is that it joins together streaming TV and digital advertising, and the confluence of these two hugely profitable and unstoppable forces makes it really a surefire growth play with plenty of gas left in the tank going forward. And the company really stands to benefit no matter who wins that larger streaming battle you're always here to talk about. So that's the basic pitch, and now we're going to go a little into more detail of Roku. So Roku makes small devices that plug into TVs and allow users to watch various streaming content from Netflix and beyond. The firm was founded back in 2002, and it grew its product line and gained impressive market share in a streaming player space that features Amazon and Google and others, large competitors. So alongside its devices, its technology is also built into some lines of smart TVs, and it was the number 1 smart TV operating system sold in the US in 2020, having captured roughly 40% of the market. The company also sells wireless sound systems that compete against Bose and Sonos and others. Roku's hardware business certainly did help it rise to prominence, and the segment continues to generate solid revenue. The company is, however, much more than a streaming device player, and its expansion into the digital advertising world has helped the stock really take off and its growth really take off in terms of top and bottom line. So Roku's ad-focused platform revenue accounted for 80% of total second quarter sales and 71% of fiscal 2020 revenue, while growing at a much faster clip compared to its player division. So Roku makes money by selling ad space across its marketplace and taking a share of streaming service, subscription revenue, ad inventory, and more. The company allows marketers and companies to buy targeted ads, promote their streaming movies, shows, platforms, and really whatever else they're selling. The company earlier this year bought Nielsen's advanced video advertising business and entered into a, quote, long-term strategic partnership with the ratings and audience metric Titan. The company then in September announced that it's launching a new app that will allow Shopify merchants to easily build, buy, and measure TV streaming advertising campaigns. The move boosts its advertising credentials as marketers clamor to reach consumers wherever they can as people move to non-ad supported subscription services like Netflix and Shopify and Disney Plus and Amazon Prime. So on top of that, Roku ramped up its spending to roll out more of its own content, including original programming on its ad-based Roku channel. Plus, the company is expanding its international reach outside of the US and Canada. So overall, Roku is set to benefit from the expansion of the entire streaming industry as millions of people cut the cord and watch everything from Sunday Night Football on NBC's app to the latest Netflix or HBO show. And according to a recent report from the National Research Group, 1 in 4 U.S. adults canceled their traditional pay TV service in the past year, with the figures nearly the same across various generations from Gen Z all the way up to the baby boomers. With this in mind, Netflix boasts over 210 million subscribers globally. Disney Plus, which launched in November 2019, has accumulated over 115 million subscribers to blow away its own guidance. Overall, Disney grabs around 175 million subscriptions if you can include Disney Plus, ESPN Plus, and Hulu. We also know that Apple and Amazon are spending hundreds of millions of dollars on original content, and both are set to continue to compete for live sports rights going forward, with Amazon already having a Thursday night football deal with the NFL. Companies, advertisers, and marketers are all fighting to get in front of eyeballs as the money is flowing to digital. So the percentage of total ad dollars spent on digital channels is projected to climb from 51% in 2019 all the way to about 68% by 2024. The overall ad market is set to reach $952 billion in 2024, up from around $748 billion in 2021. With it easily set to pass the $1 trillion threshold by 2025. So now let's look at some more Roku-based growth. So Roku's revenue has been really impressive since it went public in 2017, with 2018 revenue up 45% and 2019 up 52%. Its sales then climbed 58% last year to about $1.8 billion. And it added 14 million incremental active accounts to close the year with 51 million. Roku also cut its loss significantly from adjusted loss of 52 cents per share in 2019 to just a loss of 14 cents per share last year. Obviously, the coronavirus helped spur broader growth within the streaming space. We should also note that Roku stock fell after its Q2 financial release in early August on the back of what appear to be more near-term concerns, which was a sequential decline in streaming hours amid the economic reopening and a margin crunch in its streaming player segment due to supply chain setbacks, which the company then didn't want to pass on to consumers. So even in the face of those more near-term headwinds, Zach's estimates call for Roku's 2021 revenue to surge over 60% to $2.85 billion. This would mark its best growth yet and see it add about $1 billion more in sales year over year. And if we look back to just 2018, that's more than the company pulled in that entire year at $743 million. And then peeking further ahead, we're expecting another 38% growth in 2022, with it adding another $1.1 billion to its top line. This would extend its streak of between roughly 40% to 60% revenue growth to 5 years. And investors should be excited to know that it's projected to swing from an adjusted loss of 14 cents per share all the way up to positive $1.33 per share, and then climb another 35% to $1.74 per share in 2022. We should also note that it's seen some positive earnings revisions recently, with its FY 2021 consensus figure up 250% from where it was 90 days ago, with FY 2022 up 85% from before its Q2 report. The company has also blown away our Zach's earnings estimates in the last 4 quarters. And now we're going to move on to some stock price movement. So Roku stock has skyrocketed about 1,200% since it began trading in late 2017. This outpaces high flyers such as Shopify and Nvidia. More recently, the stock's up about 200% in the past 2 years. Luckily for investors who missed out on this ride, Roku, like many of these high flyers, has cooled off a little bit in 2021. And like Square, it's featured some pretty big up and down swings. So that said, the stock is up still 47% so far this year, but it is down about 30% since late July. So it's trading about 31% below its highs at the moment, and it's actually sitting below both its 50 and 200-day moving average, where it has not sat for very often before, and it sits well below neutral RSI level, so it certainly has plenty of room to climb if Wall Street starts to jive back into the stock. It's also trading at a more than a 50% discount compared to its valuation in terms of forward 12-month sales. It's trading at 11.5 times forward 12-month sales. So Roku's strong adjusted earnings momentum helps it land a Zach's rank #1 buy at the moment. And we should note that Wall Street remains extremely bullish on Roku, with 16 of the 19 brokerage recommendations that Zach's has coming in at strong buys. So overall, with the stock sitting about 30% below its highs, especially given its growth outlook, in the broader space for digital advertising and streaming TV going forward. It's really impressive. The company also has a pretty strong balance sheet that supports future growth. And this pullback really sets up a solid, enticing entry point for people considering Roku as a longer-term play. Obviously, you never know what's going to happen right around earnings, and that can be said with all three of the stocks we're going to talk about today. But if you're considering it as a longer-term play, it seems pretty solid bet if you're going to buy the stock 30% below its highs, given all of the fundamentals we've talked about within a growth industry, multiple growth industries for Roku. Now we're going to close out with the last stock today, and that is Etsy, which reports its third quarter financial results also on November 3rd, so next week as well. All of these stocks are reporting next week. Etsy, also like Roku, trades under the ticker that's its name, ETSY. And Wall Street had taken its foot off the gas on the arts and crafts fair style e-commerce firm, with some worried that Etsy wouldn't be able to match that hype from 2020 this year. And it did benefit greatly early on from mask sales, which are thankfully down as the economy reopens and less people are having to buy masks constantly. So that was never going to be a long-term business. So people were a little worried that maybe went a little too far too fast, but clearly the stock has surged back and investors started to jump back into the stock around mid-May, and now it's trading really close to its highs heading into its upcoming earnings results. So now let's break down the company, and then we'll look ahead to some growth outlooks for Etsy. So Etsy is an e-commerce marketplace that allows individuals and small businesses to sell everything from clothing and jewelry to art and home decor. If you've never been on Etsy, it's worth just perusing the site. The online retailer was founded in 2005. It went public in 2015. It also owns a musical instrument marketplace called Reverb, and its two-sided online marketplace has become really popular before the pandemic and certainly during the pandemic as well. The Brooklyn-based company has carved out a really nice niche within this booming industry, and it sells items that consumers might not really be able to find on Amazon or eBay, and it makes its money from transactions as well as advertising and other offerings such as paid search. The massive e-commerce arts and crafts platform also has expanded through a big acquisition. So the company on July 13th, so this summer, completed its purchase of fashion resale app Depop, which is really popular with younger people, for $1.6 billion. That was a big bet, and Wall Street has proven that they're happy with it as the stock has climbed since that acquisition was completed. The company also in July finalized its purchase of Elo 7, which specializes in unique handmade items and is ranked as a top 10 e-commerce site in Brazil. So excuse me if I butchered that, but they're expanding in South America with a big move in Brazil. Etsy was clearly the beneficiary of a crazy year last year, as we alluded to, as millions and millions of people bought masks on their site. So the company's full year gross merchandise sales soared 107% last year to $10.3 billion, with revenue up 111%. Luckily, throughout the rest of the year, after the initial Q2 and Q3 boom of mask sales, the growth was not driven by masks whatsoever. Its gross merchandise sales, excluding masks on Etsy's marketplace, was up 118% in the fourth quarter. So that was a big sign that Wall Street didn't need to be that worried. In fact, only 4% of its overall gross merchandise sales came from masks in the last quarter of 2020. So overall, its active buyers also climbed 62% in 2020 to 4.4 million, while its active sellers climbed 62% to 4.4 million, and its active buyers were up 77% to 82 million. So more recently, its second quarter revenue climbed 23% against that really tough to compare period last year, and then climbed 50% in terms of buyers, all the way up to 90 million, with sellers up 67% from the year ago period to 5.2 million. So looking ahead, Zach's estimates call for Etsy's fiscal 2021 revenue to jump 32% above its COVID boosted year, from 1.7 billion to about 2.3 billion. It's then expected to climb another 20% higher in 2022, all the way up to 2.7 billion. Investors should know that Etsy was growing before that. So just by comparison, its 2019 and 2018 sales both climbed about 36%. if you look back between 2015 and 2019, the firm averaged about 33% revenue growth during that stretch. So it's expected to pull in basically its average growth from before the pandemic this year on top of that really big 2020 figure, which is really impressive. Meanwhile, its adjusted earnings are projected to climb 10% this year and then another 13% next year. Etsy currently lands a Zacks rank number 2 buy at the moment, and its earnings revision activity has been rather strong, and it's beat our adjusted earnings estimates by about 32% in the trailing 4 quarters. So now we're going to look at some stock price movement heading into its release over long term and near term. So Etsy stock is up about 1,800% in the last 5 years, which obviously blows away the market and some other growth-focused names. So over the last 2 years, the stock's up about 330%, which roughly matches Shopify's climb and blows away Amazon's 86% and its industries, which is the internet services market on Zacks, at about 84%. So then so far over the last year, Etsy stock is up about 77%, and it's really jumped in the last month on the back of some positivity heading into its results. So since mid-May, the stock is up 58%, and it climbed about 2.64% Monday morning to just below its records at around $247 a share. And despite trading right near its highs, it trades at a 30% discount to its own year-long records in terms of forward sales at 11.5 times forward 12-month sales. And in terms of forward earnings, it's trading at a big discount as well. Obviously, it's still pretty pricey in general, so it's trading at 74 times forward 12 months earnings, but this is well below the likes of Shopify, which is still trading at sky high forward earnings valuations of around 375 times forward 12 months earnings. So Etsy's valuation looks far better compared to that. We should also note that 11 of the 15 brokerage recommendations that Zacks has are strong buys, with one more buy and the rest sitting at holds. We should note that the company has recently jumped into a little bit of overbought RSI levels, so just the often watched technical zone. So it could face a near-term pullback, but longer-term investors certainly might want to consider Etsy heading into its third quarter earnings release. And that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.